What is down by almost 50%? What is taking the wind out of the sails of the Phoenix market? We're losing momentum. Let's talk about it, you guys. We're going to start with some broader economic data, as we always do. Thanks for joining on this Monday. If you're new here, I'm a real estate broker. I'm Caitlin McKegg, and I talk about Phoenix real estate data. And we also talk about the economic data as well, because that is also important. So let's start with the CPI and the PPI. Both of these coming in a little bit hotter than expected, which is never good news for mortgage rates and the markets. So wholesale prices rose 0.7% in January, more than expected, fueling inflation increase. The producer price index rose 0.7%, higher than the 0.4% estimate. Excluding food and energy, core PPI increased 0.5% compared with expectations for a 0.3% increase. This goes on to talk about how inflation rebounded in January at the wholesale level as producer prices rose more than expected to start the year. And then we also had that CPI data come out the week before, which was not the best news either. It was just a little bit hotter than expected. In addition to that, other economic data, the Labor Department reported that jobless claims edged lower to 194,000, a decline of 1,000 and below the Dow Jones estimate for 200,000. And we also had the manufacturing index plunge 24.3, well below the 7.8 estimate. So basically, long story short, this information coming out is not helpful to our hopes that inflation was being tamed. I mean, these aren't terrible readings, but more than we expected. And this week is going to be important because we'll be getting the PCE reading, which is really the Fed's preferred method of looking at inflation. So core PCE, which removes the volatile food and energy components out, is set to show a 0.4% climb over the prior month, ticking up slightly from 0.3% in December. If realized, those numbers would support recent indications inflation is not falling at the pace and extent investors have been hoping for, even as prices have stabilized from the peaks of the current cycle. So keep an eye out for the PCE information, because that will be important to see what happens with the markets. Why all of this is important is because it then affects interest rates for mortgages. And when you are messing with that, you're messing with home buyer demand, and that affects sellers and yada, yada, yada. So what's going on with mortgage rates? It's not good. Housing market once again braces for higher mortgage rates, where 8 experts see rates going this year. So aside from the predictions in here, this talks about how on Friday, the average 30-year fixed mortgage rate swung back up to 6.8%. We were in like the high fives. We were seeing mortgage rates lows for the like a 4-month, maybe 5-month low of mortgage rates. So there was a lot of recovery, which was spurring a lot of demand. And now we're getting close to that 7% range again. Why? Because this inflation data is not pleasing anyone and not giving people the warm and fuzzies about our market recovery here. So just a few predictions. I mean, gosh, it's so hard to predict mortgage rates, but here's what Mortgage Bankers Association is saying, that they expect rates to average 4.4% in both 2024 and 2025. We will see. Average 5.2% in 2023, so in this year. Bank of America is saying that rates will fall to 5.25% by the end of this year. Morgan Stanley saying rates will fall to 6% by the end of this year. Fannie Mae expecting that it'll be 6.3% average in 2023. We've got Freddie Mac saying average of 6.4% in 2023. Moody's saying 6.5% through mostly 2023. So all of these are pretty consistent with somewhere in the 6% range through this year, with the exception of that first one who was saying, that was at Mortgage Bankers Association. I lost it. Anyway. Yeah, 5.2%, and then going all the way down to 4.4%. Wouldn't that be nice? We'll see. Goldman Sachs, 6.5%. Realtor.com, 7.4%. Oof. So those are just some of the expert predictions for mortgage rates. You can keep that in your back pocket. But basically, we'll see. It's a big week this week with PCE information. We'll see how the Fed reacts to that, how the markets react, and what then happens with mortgage rates. So if you are closely tracking interest rates for mortgages because you're a home buyer, keep close to your lender this week to find out what happens and whether or not you should lock. They can give you much better advice than I can, but just heads up, things may change this week. We'll see. So what has gone down almost 50%? This is alarming, right? Well, kind of. This Redfin article, have you seen it? Investors are buying roughly half as many homes as they were a year ago. Well, of course, everyone on YouTube that loves to have startling headlines is using this because, oh my gosh, if we have 50% of the buyer pool pulling out of the market, that is for sure going to crash the market, right? Well, this isn't as scary as it sounds, okay? So these numbers are correct. Investors bought 18% of homes that sold, down from 19%. Purchases fell a record 46%. Of course, Phoenix is hot on this list because we always are. I think it's Phoenix and Austin on this one. So they're talking about those pandemic boom towns have seen the biggest drops in investor purchases. Las Vegas is on the list. And then at Phoenix, 66.7% is the drop in investor purchases. And I think these numbers are pretty accurate, but here's why it's not super scary. Let me show you the Cromford report because they, of course, track all this information as well. And it's always interesting to watch this. And they've always been calling out, we need to watch how our owner-occupant purchases fall in line with everything else because you want a lot of owner-occupants in your market. Otherwise, you could have a very unstable market. So investor purchases definitely went up during the pandemic. No doubt about that. We hit our peak at 21%. Investors are this pink little bar here. 21% in Q2 of 2022. We really started to see a pretty big uptick Q2 of 2021. And Q2 of 2020, investors were freaked out because COVID was happening and they didn't buy anything. So we actually went down from previous averages. But today we're sitting at about 15% as of Q4 of 2022. And that is not too far off from what we were seeing over the last 5 years as an average, this 11, 12, 13%. So I'd imagine this has more to fall. But my point being, the investors have already pulled out. I mean, this is as of Q4, we've already come down from that 21%. We'll probably see maybe fewer investor purchases depending on where things go, right? But if 50% pullout on the market was going to cause so much damage to Phoenix, I think we would have already seen it because we're already kind of close to what our average had been in the past. So, just wanted to share that. I probably need to stop watching some of these other channels that fire me up about misleading headlines, but that's that. So let's talk about Phoenix, though, while we are on this topic. And first, if any of this is helpful for you guys, I'd love for you to hit the like button and consider subscribing so you can be with us every Monday as we talk about Phoenix data. So this is the CMI. If you're new here, this is the Cromford Market Index. They look at supply and demand in the market, and it helps us understand where prices are going. And basically anything over 110 is considered a seller's market, technically. And the reason this number is over 110 is because our demand is outweighing our supply right now. And we've seen demand tick up. We've seen this number continue to go up every week. And I will say, I think this might be the last week that we see it go up. Next week might be the same or lower. That's my prediction because we are seeing lower activity, contract activity in the market right now due to interest rates and all that volatility. So that's my mini prediction for next week. But we've got supply at 65. So that's technically 35% below normal for supply. And our demand is only 20% below normal. So that's the difference between those two, which is pushing this number up overall and giving us a seller's market. So let's look at every city in Phoenix and their respective CMI. A lot of these are still in green arrow territory, which means that when you look at the month over month data for that week, those cities have increased their CMI, which means prices could be on the rise, which means it is a positive thing for sellers, which is why the arrow is green. So green arrow, good for seller, red arrow, bad for seller. And we've got a lot of these. We only have what is it? I think 4 buyers markets now, 2 in balance, and the rest are sellers markets. Again, technically, according to the Cromford Market Index number. All of this is still very mild. Keep in mind, this is not the sellers market that we knew last year, because that number would have been in the 400s. But we are technically above 110, which means a sellers market. So we'll see if some of these cities start to show red arrows next week as that CMI starts to soften a little bit. That's my prediction, but we'll see what happens. Now, I talked a little bit about the volatility with mortgage rates and how that then affects demand, right? Well, we're seeing that in our accepted contracts. Here's new accepted contracts by week. We just dropped down last week. 1822 instead of the 2000 range that we've been seeing for the last couple weeks. And we started off the year hot with these accepted contracts. And now we're starting to see this go down. But if you notice past years, we have a little bit of volatility with all these little ups and downs. So we'll see if this pops back up. I don't know. My guess is that it won't. So we're starting to see these accepted contracts go down, which means that demand is starting to soften a little bit. Again, be very cautious as I say this, because this is just 1 week that we're looking at. This is not truly a trend at this point, but knowing what we know about inflation data and rates and the Fed's outlook, this could become a trend. So again, we'll see. I say that every time. We'll see. That's the best I can do. And then with that, we're also seeing active listing counts go down. So if our active listings were going up and our demand was going down, we would certainly be anticipating a slowdown in the market and prices coming down for sure. But we're not seeing inventory go up. So even though there's less buyer activity, there's also fewer sellers out there on the market, which overall just brings down our transaction volume. So we're not going to see as much activity, but it doesn't mean that prices are coming down, because the buyers that are out there still don't have a whole lot to choose from. So this supply line is staying low. We're not seeing a bunch of new additions to supply. So that will be interesting to watch. That, in addition to our listing success rate, has gone back up to 72.4%. We hit a low last year at about 62%. And listing success rate is exactly what it sounds like. It's the success of listings on the market, whether they sell or go off market for cancellations or expiring. And so the success rate is showing strength and health in the market. And we've seen that go up this year. We're still not close to where we were last year. But, if we look at 2014, the last balanced market, and kind of these years that were a bit more normal before things went crazy, we're not too far off of that number. And the Cromford report says that 70% is a healthy market indicator, anything over 70%. So that's where we're at. So that's good news. So we'll see how that continues. And I wanted to just read a quote directly from the Cromford report, just because they are so, I'm sorry, I didn't realize this was not showing this whole time. So there you go. There's the full picture. Because they quote things, they can say things better than I can, right? So basically they're saying the result of all of this is that the market will see balance moving in favor of sellers, which will help support pricing. The volume of transactions will not rise as quickly as it would have if rates had stayed as low as January. We are seeing increased closed transaction rates, as you would expect for this time of year. The listing success rate has also recovered and now stands over 70%, consistent with a healthy market. Basically, the correction in pricing has run its course, and we are now back to a normal market far less frenetic than we experienced between 2020 and 2022. So that's their most recent outlook considering all of this data. So that's where we stand with everything here in Phoenix. If you have any questions, feel free to reach out anytime, or if you want to check out some of those resources in my description below, I have a link to get a free home value. You can search my MLS, or you can set up a discovery call with me if you just have some questions about your situation. So thanks for joining me this week, you guys. I appreciate it. Drop comments below. Let me know what you think about all this info, and I'll be back at the end of the week with some more interesting real estate info. I'm Caitlin McKegg with the Desert Dreamers team.